He's angry about mortgages. It's Angry Mortgage. He's swearing. He's cursing loud. He's old. He's opinionated. And he's been doing this so damn long. This program is about mortgages, and this is mortgage advice, but the advice may not apply to your situation. Contact licensed mortgage professionals for specific recommendations before you make decisions about mortgages. You may not agree with Ron, but if you don't, he thinks you're wrong. Oh, and did we say there is a lot of swearing?
Hi, folks, a special edition of the Angry Mortgage Podcast. Very proud to have Nick Kyprianou, President and CEO of RiverRock Financial, right?
Mortgage Investment Corporation.
RiverRock Mortgage Investment Corporation.
You got it.
You know what I like about Nick? Nick's old school in the best possible way. You know, I always say, if you're in the mortgage business, call the goddamn company mortgage. Okay, like that's right. Your business, all right? I
agree.
Call it mortgage. All these guys are calling it capital and calling it finance and calling it financial and calling it architects and every other call it a mortgage company. You know, just anyway, that's my opinion.
I agree.
So I've known Nick for a long time.
Yeah.
How long have you been doing lending, Nick?
37 years.
37 years. God,
Yeah.
You look a lot better than me. That's for goddamn sure. I mean, Nick takes care of himself.
That's right.
Yeah, you do. I know you do. So I've known Nick for about 27 of those years.
Yeah, about that.
Nick was the president of Home Trust.
Correct.
And left that company, went to you were with that went through some name changes too.
Yeah, when I went there, it was called Grey Horse. They were
Right.
just a transfer agent.
Right.
Then I got the license, and we changed the name to Equity Financial Trust. And now they've changed the name to Haventry Bank.
Right. They could never settle on a name, right?
Yeah, I think they have now.
So now in your own thing, it's been about 9.5 years, correct? Okay. So I'm going to tell this story because I love this stuff.
Mm-hmm.
So Nick started RiverRock from nothing. Okay. Like Nick did literally every single thing.
Right.
Nick was the treasury. He was the underwriting.
I had one employee.
Yeah, at one point. Like, I'm not going back.
Yeah.
I'm talking about the beginning, the very beginning.
yeah.
Okay, the very beginning, because, and he was even the sales guy. He would call
Right.
brokers looking for business.
Yeah.
Okay,
I said I was a chef, cook, and bottle washer.
you did everything.
Yeah.
Okay, and this is what I love, because this is taking nothing into something from nothing. Like, people don't understand how hard that is, right? Like that is.
Same with equity. Like we didn't have a bank license.
You didn't have a bank license.
Got a bank license, had to hire people, start lending, like started from nothing.
And when you were the president of Home Trust, it grew like incredibly.
When I started in Home Trust, February 1992, we had about 200 million in mortgages under administration.
Oh my God.
And when I left 18 years later, we were in around 16 billion.
Yeah. Folks, sometimes we get the wrong impression. You know, when you're a mortgage broker, you just sort of look on these companies and says, oh yeah, they're big companies. They got the money, they just have to lend the money, blah, blah, blah. It's just not the goddamn case. Like these are, particularly like the situation at Home Trust where they grew the company again from almost nothing.
Nothing.
Okay.
And almost during the early 90s, almost died.
Okay. I mean, tell the story about the airport. Tell a story about the airport in the 90s. Okay.
We would have so many properties in arrears.
Because it's the 90s, folks.
Early
it's the 90s. Okay.
So many properties in arrears. And back then, before in the late 80s, before I got there, they were doing industrial, commercial, warehouses, motels in Niagara Falls. Like I was always saying, C-grade strip malls with like Sarah's Nails and ABC Variety. So of course, everything was going bad because it was the early 90s. And we were having all these arrears, but we couldn't afford to take the hits. Like we couldn't afford to sell the property and take the hit. So what we would do is we'd do the underwriting to generate some fees. And then Jerry used to say it's the airport and all these properties were circling. And then he said,
the crap property.
The crap property. And he said, okay, we can land this one to take the hit.
Because we got it enough. We got it enough
That's
that we
right.
can,
It was good. Like I used to say, I remember some Fridays they said, we're going to be open on Monday. He goes, Monday, yes. Tuesday, I don't know yet.
We got to land some more planes.
It was stressful.
Jesus Christ.
It was a very stressful time.
which also, by the way, shows that how talented people working hard can accomplish just about anything.
Got a lot of luck, let me tell you.
Good fortune, yeah.
Got a lot of luck.
All right, so like Nick is so seriously an expert at this stuff. Nick is an expert at private lending, at operating a MIC at a deep level. Like, you know, I know sometimes we got a lot of listeners all across Canada. Some people out west may never have heard of RiverRock, but the truth is that this is deep expertise. Like, this is the real thing. Like, this is the most well thought out. You know, I can't discount everybody else. There's some other great people in the MIC business.
100%.
Mortgage Investment Corporation, folks. For the general public, it's a Mortgage Investment Corporation. So, Nick, tell us how you've developed your philosophy of how because you're very specific in how you do mortgages and how you do lending. So tell us about how you developed the philosophy.
And it all came from the early 90s, right? Because I always say you learn the most when you screwed up terribly, right? So, and in the early 90s, like I said, I told you what kind of products we were lending on. Industrial, commercial, strip malls, motels in Niagara Falls run by families, crappy houses in small towns, like just a mess, real mixed bag. But when everything was going to crap, right? Because you have to remember I always say values drop when there's triggers. The more triggers, the more value dropping, right? So in the early 90s, we had multiple triggers, right? You had unemployment over 12% in Ontario. You had manufacturers leaving Ontario to the southern states of Mexico because of high provincial taxes. Jesus. You had mass speculation in the housing market. So
that was in the late 80s.
Late 80s, early 90s.
Super speculative.
So basically back then, you could build a condominium tower with 0 pre-sales.
Come on.
Yeah. So, and then builders or developers would say you can buy a unit with $500 down and you don't have to come up with the balance of funds until closing. So, you know, taxi drivers would pull up and say, well, why buy 1 when I can buy 5? And then when the building closes, I'll sell 3 and I'll have 2 free and clear. This is a no-brainer. It's math. Wow. Right? So, and then builders were building out streets with no pre-sales. Well, and then you had rates go from 9 to 15%. You had the Quebec referendum. And then to add complete icing on the cake, you had a NDP government win a majority that created absolute chaos in the province.
Oh my God!
Right. So you know we used to say, is that a train? Is that the light at the end of the tunnel or a train coming? Right. Like it was just one bad thing after another, and values kept on dropping till about 1995.
Right.
Commercial industrial took the biggest hit in values, but during that time,
some developers went broke too.
Oh, lots.
Yeah. Okay.
Lots.
All right.
But what I remember during that time was, you know, you have a banquet center or a strip mall with no tenants. Here are the keys. Like
they walk away.
I can't do anything.
Yeah.
Right. And these things are all based on cash flow. So with rates going up, you can't sell it, or if you sell it, it's a big loss. And not everybody wakes up and says, you know what, I'm going to buy a banquet center today or a strip mall.
Like, it could just sit. Literally
just sit for a year or more. Yeah. But people, you know, love their houses, right? There's a real emotional attachment to your house. And I always say your principal residence is the top of the pyramid.
Yes, it is.
So what I found was back then, if somebody did run into trouble, they became very resourceful. They got a second job.
Trouble on their mortgage.
On their mortgage, on their house.
Yep.
Because they, you know, because of the emotional attachment, they're entrenched in the community, the kids go to school in the neighborhood. Yep. So they did whatever they had to do. They changed their lifestyle. They took on a boarder or tenant, went to family for help, took a second job. They did whatever. Now, I'm not saying everybody
because
made
some people
it.
Can't. Right.
You know, if somebody died or they lost their jobs and like can't get another job, like there's some hardship cases that they can't solve the issue. But for the most part, they're making their best effort. And then on the flip side, if they can't do it and you take the house back, you can always sell the house.
Somebody
it's
will
just
buy
about
the house.
price.
Yeah, price.
Just about price, right? And we would see it. We would list a house, do an open house, nobody would show up. Drop the price, nobody'd show up. Drop the price, all of a sudden people started to trickle in, right? Like it's as simple as that. This isn't rocket scientist. I'm not that smart. Like if it was that complicated, I couldn't do it. So that's how you manage it. But with the other types of real estate,
sometimes there's no buyer.
There's no buyer.
Yep.
Like the rates didn't work, no tenants. Who needs an industrial building in Timbuktu? Like it didn't work. So I thought, you know what? I don't want grief. I want stuff that's easy to manage. So when I started Equity, I did it the same way.
Yep.
When I started RiverRock, the same way. Middle class, urban, suburban homes in Ontario. A lot, like I said before, and we talked about this, Ontario is the most lender-friendly province in Canada. You can deal with things quickly. You have a lot of power.
Lender-friendly in terms of when something goes wrong with the
When
mortgage.
something goes wrong, you can expedite quite quickly and get things moving and create the crisis for people to kind of deal with it.
Okay, so I love and I am fascinated by your approach to this stuff because it is just always strikes me as effectively flawless. Okay, so because and we'll get to why other lenders do things differently in a minute, but so your lending is highly geographic.
Correct.
And highly specific. So
Correct.
Tell us a little bit more about that.
Yeah, so we like urban, suburban areas in Ontario, right? So we like homes that look like everybody else on the street.
Right.
One reason is they're easy to evaluate, right? We make a couple of adjustments for condition.
No big appraisal mistakes.
Yeah.
Okay.
Like if everybody's selling for $750 on the street, you're not going to get one for $1.5 million, right? It doesn't happen. So we like urban, suburban areas. We don't like...
But not every town. Not every town.
We don't like rural properties, right? Like I say, like first of all, drive out into the country, try to find two houses that look the same. Very hard. So hard to evaluate. Secondly, when people tell us, oh, this is a very marketable house. And like I said, if they were that marketable, why don't they have a neighbor? Right? Middle of nowhere.
There's nobody there.
Nobody there. Same with these small towns. Nobody wants to live 30 miles east-west or northeast of Frobisher Bay. Like, you know what I mean? There's not a lot of opportunity. So we stick GTA. We go as far north as Aurelia. We go as far east as Bowmanville. We do the odd deal in Belleville or Kitchener, or Belleville or Kingston. And then we do Greater Ottawa. We go as far west as London. We used to do Windsor a little over a couple of years ago. We stopped Windsor, and then we go all the way around the lake, Hamilton, Niagara region. But we're very specific. Like we know our areas, right? And we always say all of our business comes to us as licensed agents and brokers. And we always say, we have a preferred appraiser list, but it doesn't mean that guy can't have a bad day. So
the appraiser could make a mistake.
Anybody can make a mistake. I make mistakes. In the office, we have a two-person sign-off on every deal. Anybody can have a bad day, right? So it goes through that process. So we do a deep dive. If we go back to the appraiser and say, we disagree with your value and here's some additional comps,
so you drill down on the appraisal. You just don't accept it. You go to town on it.
Big time.
All right.
Right. And if we agree to disagree, we'll use our number. Right.
Gotcha.
And then, like I say, our philosophy is bad things happen to good people. As I mentioned, we had that
you
phrase.
Trademarked it.
Exactly. Trademarked it because it's true. People get sick, they die, they get divorced. Bad things happen to people, good people, all the time.
Constantly.
Right. Constantly. So we say, okay, if that deal, something bad happens to that person the day after we close and it cracks,
they didn't make the first payment,
right? Yeah. Or even in 6 months they didn't make the payment. We reverse engineer our numbers. We know what all the friction costs are. We work it all through. And if we don't see a clear path to an exit with all of our money, we either reduce the loan or decline the loan.
So that's for folks who are, because there's a lot of mortgage brokers who listen to this podcast. And a lot of people in the general public, which we love because they learn more about how the mortgage business works in a basis that they're not just getting the mortgage for their own house. They find out how it actually works. But particularly for the mortgage brokers, you said friction. So just everybody, in business, we should really understand that term. If we're really in business, we should know what friction means in business. But if you just explain what the different items that go into friction when it comes to dealing with a power of sale.
That's right. So you got your legal cost. You have no control over those. The lawyer's going to charge you the lawyers, and lawyers don't budge on their fees. And then you've got the interest the meter's ticking. Interest is still calculating. Yep. If they're not paying their mortgage, they're not probably paying their property taxes. No. And if it's a condo, they're probably not paying those either.
Absolutely not.
Right? Then you have real estate commission. Now there's a little bit of flexibility there.
But you got to pay someone to sell that house.
Got to pay somebody to sell the house.
Yeah.
I'm not going to go out and do it.
No.
I don't have a license.
Yep.
So you got to pay somebody to do it. And then you got to also factor in market costs, right? Like there's always a little bit of ebbs and flows with the market.
Well, you've even got property management to do, right?
We have a property management company that we've worked hand in glove with since day one, that I've worked with in my past lives.
But that's more the friction. That's you've got to actually look when the people have left the house, because sometimes people abandon houses, right?
That's right.
It happens. Okay, so you've got to look after the house like it's sold.
Listen, you got to cut the grass in the summer.
Yep.
Got to shovel the snow in the winter. You know, we took a house back during the pandemic. We went and there was 6 inches of water in the basement.
Oh my God.
Had to drain it all out, set the fans up, fix the leak. They got it all done before we could list and sell.
So for all the mortgage brokers out there who think that lending these MICs and these private lenders, even people as big as Home Trust or EQ Bank or Community Trust, if people think it's all just profit and
That's not.
unicorns
I always say
and
this
roses,
this is not a business for the meek or mild.
Yep. So because this friction, if we just get really basic about it, we've appraised a property and decided that this is the value, and you've done your due diligence to really, you feel good that it's the value, but you can't control the market. Stuff happens.
Control the market.
Okay, stuff happens. Like we all know, in March of 2022, the roller coaster reached the top.
That's right.
And it started coming down.
Right.
And if you appraised a property in 2021, by June of 2022, it probably wasn't worth the same. It's probably worth a little less.
Yeah.
Okay. So you've got to manage that problem. And then what people don't understand is when the home goes through the power sale process, some people refer to it as foreclosure. It's called bank ordered
Western
sales.
Canada uses a
Bank
foreclosure
ordered
process.
sales.
We use a
British
power
Columbia.
sale process.
Yeah, exactly. So there's a lot of different names for it across Canada, but it's the same idea that sooner or later the lender who is not getting paid on their mortgage has to take the house back and sell it. Okay. Now when everybody thinks, oh yeah, that's easy or easy to sell, everybody wants to buy a power sale house. Well, there's all the in between. That's the friction Nick was talking about. There's all the in between, and guess what? It's got to come out of the value of the property, or if it's so much friction, so much extra cost, you're starting to intrude on what you can get out of the property.
Correct.
And you may take a loss.
Correct.
Now, I don't think you take a loss very often.
Very rarely.
Yeah. Okay.
We took our first loss this year.
What happened?
It was an unusual case. They went into default. Then we started our action. So a big thing that people do now is, this is a big part of the internet, is that people put up defenses.
They file a defense. But there's really no defense.
There's no defense.
They didn't pay.
I always say to people, the mortgage contract is the simplest contract in the world.
Yes.
We register a mortgage against your house. We're going to give you the money. We have a prescribed rate, a prescribed monthly payment. All you got to do is make the payments. And then at maturity, you either renew or pay us out.
That's it.
That's it. So what's your defense?
That's what I keep telling people about the mortgage contract too. I say, it's one of the most beautiful and time-tested, because it's very old law, time-tested contracts in the world. If you make the payments, pay your property tax, and keep up your house insurance,
you're good.
Bank can't do anything.
That's right.
The bank has got a responsibility to say, yep, you get to keep the money as long as you do those things.
That's right.
We can't ask for it back. Okay.
So in this particular case, it was odd because it was a single individual, and I went into arrears, and then we started our action, and all of a sudden, a lawyer sent us a letter saying, "I represent the wife," and we didn't know about a wife.
Yeah.
So we said we weren't aware of a wife. He said he was single. And then
you have all kinds of documents to say he's single.
Correct.
Yeah.
And then she sent me a bunch of the lawyer sent me a bunch of wedding pictures. And I said, it looked like they had a very lovely day. Yeah. However, I need a marriage license.
Aha.
They were never able to provide the marriage license.
It was a complete scam.
Yeah.
Jesus.
So then he left the country and loaded it full of tenants. And they kind of beat the house up a bit. And eventually we got everybody out. And
that takes time.
That takes time and energy. Right? Because we had to deal with the defense, and then we had to deal with, because it slows you down.
So the meter's running on all those expenses.
The meter's running. And the lawyer, and then don't forget, every time my lawyer touches it,
more money.
More money.
Yeah, more money. That's right. Yeah.
So we did about $20,000, which was nothing, but.
No, that's incredible, because you're running a business where you have like an annual turnover of about $250 million a year.
Yes, right. Yeah.
And you've had
a lot of churn.
One friggin' loss?
Yeah, we've lent out well over $1 billion, and another couple of other ones, but they were small. Like they were, even our Deloitte is our auditor and accounting firm, and they said these aren't even material.
They're not even material. They're so
They're so
small.
small, they're not
so
even
small.
material.
Oh my God. So
and then what we do, we're a little different than most. We eat the loss. We don't pass it on to our investor.
So the corporation itself eats the loss. The investors made a whole.
Now
every
you can't
time.
say you're going to do that because it's against OSC rules, but we do it.
Okay. Ontario Securities Commission, don't listen to this.
The small losses we've had, we've eaten them.
Because they're like rounding
errors.
Exactly. Okay. Now, folks, as you're listening to this, watching this, I want to tell you how absolutely wild it is that a MIC, who is essentially the design of the company is to lend to people who have some bruised credit, some people who have some difficulty proving income, some people who are new to Canada that haven't quite established their work pattern yet. And that's so everything that the bank won't do. And what I'm hearing from Nick is he's got a better default rate than the bank has.
But we would be more aggressive on the collections, right?
Gotcha.
So, we've talked about this several times. Why I decided to create the MIC after Equity Financial Trust is I left in the end of 2013, but in 2012, OSFI introduced B20, the first iteration of B20.
Right.
And
B20 is like
the residential underwriting guidelines and policies for regulated companies.
It's bank rules.
Right. Like the stress testing you read about now is all part and parcel of.
Although that
B20.
didn't happen back then. That happened later. I think it was 2016 or 2018.
Like that.
Yeah, that's
and
right.
then they bumped it up after that too.
After that, yeah.
So I really saw them sucking the juice out of the space. And not only that, really kind of pulling back, right? So what I saw was, Home Trust, Equitable Bank, Community, had this area of alternative lending just under what the banks would say no to, but it was still good business.
Good business.
All of a sudden, they got pushed out of that space. And I saw there was a void there. So I said, well, the Mortgage Investment Corporation, I can just slide in and take that void. They've just given it to me.
And have you ever been proven to be right? I mean, in such a meaningful way. And we're going to do a whole different podcast someday on this whole subject. But what? By the way, you've heard this because you're a stakeholder in the industry. The regulator, the bank regulator, the Office of the Superintendent of Financial Institutions, is going to do more tightening.
100%.
For the love of God, they're going to do more tightening. Yeah. Here's what I'm running off topic, so I'll come back real quick. But here's my belief. My belief is that, Canadian banks are going to become some kind of super secure organizations. They're going to be so regulated that it's almost impossible for them to lose money on mortgages because they'll have such tight underwriting, such enormously difficult guidelines. So what does that mean? Hell, that means that a lot of ordinary Canadians, good people who just want to buy a house, they're going to be pushed out of the banking space.
But you're seeing that on the private credit side too, like
Absolutely.
BlackRock, Third Eye Capital.
Yep.
The banks aren't as nimble and they're not interested, combination of the two, and there's a big opportunity there.
But that in a lot of ways, because you remember this well. So when you started in the business, when I started the business, the bank would often do a mortgage for someone where the income was hard to tell.
Oh, yeah.
But it was 40% equity. It was 50% equity.
And they were a long-time
customer.
They were done by the branch manager, right?
Yeah, of course.
So his business was maybe in the neighborhood.
Yeah.
They had a long relationship. He knew he was a good guy. Those relationships don't exist anymore at the branch level, and the branch level has no power.
Computer decides who gets a mortgage today. Like it's a
Correct.
combination of credit scores, fit in a bunch of boxes, hit a bunch of points. And
But you know what? If I was running a bank and had 50, 70,000 employees, I'd run it the exact same way.
Yeah, because you got to build in a lot of fail-safes. You're right. But here's my thought on the regulator. They're tightening this thing up so much because they, as a regulator, don't actually have to give a shit about the Canadian borrower.
Right.
They only care about the bank.
So when I was working for a regulated institution, and we would have meetings with OSFI, and they would talk about a new initiative they were going to implement, and I would say, that really hurts consumers.
Right.
And they would say to me, we don't care about consumers. Our mandate is to protect financial institutions and make sure they are strong.
Okay, so this is something that all of us should be aware of as a country, as a society, as Canadians, okay? We've got a lot of regulators who've been regulating the shit out of Canada for the last 30 years.
You always have to know their mandate.
Exactly. And where we end up with a Bank of Canada whose actual focus today is to bring about a recession so that inflation will be destroyed. Well, that's reality, right?
Well, I always say when you're a hammer, everything looks like a nail.
Everything looks like a nail.
Right? Okay. So they only have one tool.
That's it. And they have an absolute desire to hit their number. They want 2%.
That's right.
Okay? And they absolutely do not care how many people lose their jobs to get to that point. They don't care how many families suffer through 300% increases in their interest rate. Okay, they do not care. And then we flip to the bank regulator, who couldn't give a damn about a borrower. No, borrower's the enemy. We want only perfect borrowers for our banks. Okay, and we don't want any part of any risk. We want to take risk right out of the equation through a vast matrix of rules. Mm-hmm. And yet, perfectly good people who 30 years ago got that mortgage because the bank manager looked at their accounts and thought, well, you guys always have $100,000 in your account and you pay your bills on the screws perfectly. We can even see the movement of the money through the account. We've known you all this time. You're a great customer. We could give you that mortgage because we know you.
Right. Okay?
Those days are done.
Done.
And is that, and to the next point, you don't want bank managers deciding who gets a mortgage now, or we end up with the guy at the provincial government who just opened up 800 accounts and started fraudulently draining all the money out, pretending that he was taking money for CERB, or what was the provincial version of CERB, right? Anyway, he stole like millions and millions of dollars. So you want systems in place. But here's my point. I don't think it would kill any bank harm any bank in this country to give a mortgage at 50% loan to value, so half the value of the house, to very high beacon scores who have just a reasonable amount of net worth, okay? Wouldn't hurt them.
Well, there's
but they're not going to do it.
They're not going to do it, but there's 2 points to that.
Yep.
One is how many of those people exist?
It's a small number.
Okay, it's a small number. The second part of it is banks don't put a lot of my model is we put a tremendous amount of weight on the value, right?
Of the real estate.
Real estate. Yeah. We get the appraisal, but we also do a deep dive, right?
You get online and you study it yourself.
The banks put very little work into the values. They put the vast majority of their work into the covenants.
To the borrowers. Of who is the borrower.
Who is the borrower? Their past history was a good reflection of their future history. So when you start saying, okay, we'll do 50%, you open yourself up for fraud, right?
Okay, all right.
You know what I mean? Like you'll lose more than you win.
But high beacon scores, I don't know.
Yeah, but you know what? 50%, they'll do a drive-by. Like that's bad things happen when.
So
things
they won't.
Like that happen.
Okay, I get your point. They won't necessarily do a great job on the real estate, which is something that's important. So, because Nick's absolutely right. The whole focus of mortgage lending. If you think back to even the biggest mortgage lender of this country at one time was Canada Trust before it became part of TD. Mm-hmm. And they put a lot of emphasis on real estate too. Mm-hmm. They thought about it a lot. They're a big organization too.
Huge.
And that you're right. That's the truth of it. It's died out. The interest in the real estate
you can't be everything to everybody.
Right. Because now, just to get back to the real estate for a second, because I think it's a fantastic subject for brokers to understand how private lending really works, private mortgages really work, is the emphasis on the real estate, because that's what, if it's done properly, that's what mitigates risk.
Right.
Enormously.
But I don't think everybody folloes that model.
No, they don't. They don't. Trust me.
That's our model, but not everybody follows it.
But I think it's a great model. Okay.
Yeah, I do.
Because, but I've watched it too. Like I've observed it. Okay. So we're talking about a situation where you don't do construction.
No.
So why don't you do construction? Why not? Others do. Why not you?
So first of all, you can't get the returns to warrant the risk.
To justify the risk.
To justify the risk, right? And the other problem is, if you're really strong, the bank will do it for you.
If you're super strong.
Right?
Yeah.
But if you're not strong, you end up having to go to an alternative lender like a MIC, right?
Yep.
So what happens is, because I've been involved in this and Home Trust, we used to do some of these, and they generally don't end well, right? Because what ends up happening is the couple will hire a general contractor.
Yes, they will.
They'll get their plans, they have their budget, and then about the 70% mark, they circle back and they say, we're out of money. And we go, how can you be out of money?
Where to go?
And then what happens is they make changes during the
which are always upgrades.
All upgrades, but the problem is a lot of these upgrades don't add value.
They're just
like
what they
I'm
wanted.
being facetious, but like the gold toilet or things like that. Like these add-ons that they've done. Like I had hardwood floor imported from Italy. Like nobody cares. Like nobody's paying for that, right? But it cost me 5 times what normal hardwood would.
But
cost.
you could tell your friends when they're stepping on it that this is a famous weird wood. Yeah,
exactly.
Right,
so nobody. But that's the problem. So it becomes a very exhausting. And now you don't become the lender anymore. Now you become partners with this
partner
couple.
in a construction project.
You're partners in a construction project, and I don't want to be partners in a construction project.
No, you're right. And
so we just stick meat and potatoes, residential homes.
But some people do small commercial, like
Sure they do.
storing apartments.
Lots do.
Okay, but you don't.
We don't.
And that is because?
You know what? Not everybody needs to store an apartment.
True.
Rates go up. A lot of these people, they don't work anymore, right? Like during the pandemic, people weren't paying, right? Like people were paying their houses, right?
People were paying their houses.
They found a
but
way.
if your business got in trouble, you didn't pay that. Yeah.
You didn't pay. Like it's not everybody needs to store an apartment.
So,
not everybody needs a commercial property.
So your approach has always been high focus, like just a laser focus.
It's about discipline and process. I always say, don't get distracted by the shiny pen.
Right.
The shiny pen being big fee, big rate.
Big fee, big rate. Now, let me tell you, I've used RiverRock as a mortgage broker, and one of the things I was really impressed with, and I tell it to everybody, and I even put it out on social media. When you guys say yes, like you look at the appraisal, and like you said, you do a deep dive in the appraisal, and you are very, very focused. Look, if we're only going to lend to 70%, that's all we're going to do. Don't beg us to change. This is this is our decision, okay? But once you've seen the appraisal, once you've decided what you're going to lend to, and once you've had the basic review of that applicant,
we close.
Yep. You close.
Right.
You just close. There's no change nothing changes.
But one philosophy we've always had is if we've done all of our due diligence and we've said, yep, we're good. No conditions. We instructed the lawyer.
Close.
We're ready to close. But then all of a sudden we find we made a mistake. We eat it. Like to me, we gave you the green light. You gave us, we told you it's all done. If we made a mistake, we'll eat it.
Now, folks, for you, those of you who are not in the mortgage brokerage business, there are lots of lenders in the mortgage investment company space who about 3 days before closing said, "Oh, you know what? We can't do this anymore.
Right.
You know, we discovered this." I mean, what do you mean you discovered this? You've had the file for a month and a half. How can you discover it today? No, we have, and we're not proceeding. Okay.
Right.
Your reputation is, if you've issued the commitment, you've looked at those key points, you're going to close.
Correct.
Every single time.
If we told you you've satisfied every condition, it's done.
It's done. Okay. Now, folks, for the borrowers and consumers out there, for just the average public listening to this, they might scratch their head and say, "Oh, wait a second, like, shouldn't it be done? Like, if you say it's done, shouldn't it be done?"
No.
But all the mortgage brokers listening will tell you, no, lots can go wrong.
Correct.
From the time a commitment's issued. And some of it doesn't make any sense as well. And somebody who will stick by their word and say, "Nope, we had our look. We studied the hell out of it. We should have looked under every rock. And if we missed looking under a rock, we're still going to fund this deal."
Right.
Okay. That is a gem. I'll tell you what. There's a couple of others like that, but not too many. And look, the other thing I would say about your operation, and I think you would agree with me, is you are never chasing the lowest rate.
No.
That is not why you're here.
No.
Okay.
We want to make money, right?
You want to make money. But you are, it's a fair rate.
It's a fair rate.
It's a market
We're in
rate.
the market.
In the market.
Right now, our deal is probably one of the best deals in the space.
There you go.
I think. On the first mortgages, anyways.
So to educate, to try to let mortgage brokers, there's one thing I've always noticed about mortgage brokers. In some ways, mortgage brokers and agents are a bit like some car salespeople.
Mm-hmm.
Like some of the car salespeople's knowledge of how the car works is, well, you stick the key in there, or you press this button.
Right.
You have a fob, you press this button. See, I actually said stick the key in something, which there's a bunch of people under the age of 35 are saying, "What's he talking about?" But yeah, here's the fob, you press the button, the car leaves the lot. That's all I know about how the car works. But the reality is there's a lot going on. So could you tell us a little bit about how you fund mortgages? How do you how you get the money in to do the funding of these mortgages?
Right. So, big part of it is investor capital,
right?
And we pay a return to our investors, right? So MICs are, I don't know if everybody knows how a MIC works, but it's a flow through in the Tax Act, right? So MICs don't pay any income tax. So that's how we're able to pay a superior yield.
Gotcha.
Right? So our F-class share today is paying 8.5. If you do the dividend reinvestment program, so that means you don't take the monthly income, you keep rolling it, you end up with an 8.84 return.
Gotcha.
Right? RSP eligible, tax-free savings account eligible. So we raise capital through investors. So we do that through Investors Direct. We do it through investment advisors. We're lucky enough to have a partnership with 9 Point Partners. We're on their platform where they raise a tremendous amount of capital for us. Then we also have a syndicated bank line of credit. So we have 3.
So explain that a little bit.
Yeah. So once you need to borrow a certain amount of money, like a bank will lend you a certain amount. I don't know where they hit the ceiling, to be honest with you. But once you need more than that, the banks won't take on one bank won't take on all the risk. So what they do is they syndicate it and they share it with other banks. So we have 3 banks that have our line of credit. Royal Bank's our lead banker, but we have other banks that are in the syndication.
So that line of credit produces what would theoretically be a reasonably low cost source of funds.
Yeah, it's a lower cost than the investor capital.
Right.
And then we're able to take chunks of money that we owe on our line of credit and lock it into CDOR for 30, 60, 90 days to even bring the rate down even lower.
Got it.
But like I said, you need a very sophisticated cash management treasury group to manage that, right? Because there's lots of moving parts, right? You have investor money coming in, some investor money going out because people need their money.
Yep.
Then you also have mortgages paying out and you have mortgages funding.
And by the way, the mortgages paying out is not necessarily all at renewal. It can just happen, right?
Yeah, like why I always say we're a parking lot, right? Nobody gets a mortgage from RiverRock and said, I'm a lifer. Right? The goal is to get you back into the bank as soon as possible. So whatever issue you had that you had to come to us, we hope that you can work your way through to go back to the bank. So people are with us 1, 2, 3 years, and then they generally, some longer, but then they go back to the bank.
But you do offer renewals, which
Yes.
not every margin. Some private lenders, either the renewal is a crapshoot. You don't know if you're going to get offered a renewal.
We
or
offer
not.
a renewal as long as they're up to date.
Right.
Their taxes are up to date.
Yep.
And that's it. They got to be up to date. And like, even if they've had a spotty payment history, we'll offer them a renewal, right? But their taxes have to be up to date, condo fees up to date, and they have to be up to date.
And that's something that everybody out there should be aware of with who's listening and watching should be aware of with anything that's not a federally licensed or provincially licensed operation, financial institution, is that the renewal is unknown. I mean, there's lots of companies don't renew.
Yeah, like a lot of private individuals, like there's some individual
Sure.
says, oh, you know what? My kid's getting married. I need the money.
Yeah.
Right? Like I'm calling the mortgage.
Yep.
I'm not renewing.
Yep.
Then you got to scramble.
By the way, if we're honest, sometimes it happens with MICs. Sometimes it happens with your peer group.
Yeah, like, if you have a lot of redemptions or you don't have, not every MIC has a line of credit.
Exactly.
Right? So cash is a problem sometimes for some people.
Exactly.
So, you have to, cash management's a big part of the business.
And by the way, for the mortgage brokers listening, this is much more crucial in the real world than you think. Okay. Like if you're saying, well, okay, I've got a guy here who'll lend the money to these customers of mine. And it's just a guy. Okay. It's just a person, but his rate's a little bit better and his fee is a little bit better than these MICs. So I'm doing my borrower a real favor.
Right.
No, you may not. You may not be doing them any favor.
Say you did a deal in early 22
Right.
at 70%. Now the property's worth 80%. Well, where are they going? Because they got to pay all the friction costs to leave, broker fees, lender fees,
Appraisal
lawyer
fee, legal
fees,
fee,
appraisal,
name
all
it.
of it.
Yeah.
They can't do it.
Yep.
So if that guy's calling that, and at that level, they're done. They can't do anything. They got to sell.
That's exactly right. When you're depending on smaller organizations or individuals for private lending, your customer can have one incredible surprise on renewal that is devastating. Could be financially devastating.
100%.
Okay. So yeah, it's really important to know who you're dealing with when you're dealing with private lending. It's so important. Now, Nick, recently the provincial government here in Ontario, and they're trying to catch up with some other regions who are tougher on this. And interestingly enough, just yesterday, the provincial regulator of mortgage brokers announced they were going to do criminal checks on every mortgage broker application in Ontario moving forward next year. Just a fresh announcement just came in.
That's interesting because I thought they did that on when you applied for administrator's license.
They do, but they don't for just regular agents and
I
brokers.
didn't know that.
Oh yeah, no, you could be a principal broker and no criminal. You could be.
I did not know that.
You could have a record. Like you're supposed to declare it, but nobody
that.
checked. This is Other provinces do. Other provinces definitely do criminal checks.
I think that's a good idea.
It is a damn good idea. But another thing the regulator's doing is they're talking about more and more supervision of private mortgage lending through brokers and agents, which of course is a great thing. But is it really the right way, or should the education process be improved for all people involved? What's your thoughts?
I have a strong view on this, right? Like this level 2 that they've introduced, that you have to be an agent for minimum 2 years before you can take the course and write the exam to be able to deal in mix or privates.
Correct.
But I think, first of all, getting an agent license in Ontario, mortgage agent is like so easy. It's ridiculous. What's it take? 2 weeks. Yeah. It's like it's almost like if you can fog a mirror. Like it's that easy. BC, you got to go to UBC. It's a pretty intensive course, pretty intensive program.
Real exam.
Yeah. Ontario years ago used to be run by Seneca College, and it was very similar, very intensive, long, big exams. People failed.
Yep.
Nobody ever fails the agent course unless, English is your 5th language.
Well, English or French. Yeah.
So I think that instead of doing this, which is not that hard either, this level 2, why, and I brought this up and, a lot of people don't agree with me on this and a lot of people get angry about this, but I personally believe right now the education process is run by the associations, the mortgage associations.
Right. The parameters are set by the regulator, but in many cases, the actual education itself
is executed by
the associations, or there's one big private educator. Yeah.
Right. I personally feel that we should give education to private educators.
Or to real
educators. To real schools. To real schools, like back to Seneca College, or work something out with a university or another college. I'm not saying Seneca College has to be it. Right. I'm not playing favorites, but a professional educator should be teaching courses, not associations. Like, it doesn't make any sense to me. Make it more robust. Make it more difficult. Like, you're giving people, for the vast majority of people, the house is the largest investment they are ever going to make in their lives.
Correct.
So you're going to allow somebody that's never had a mortgage, never owned a house, and has taken a 2-week course to give those people that advice. It makes no sense.
You're right. There's nothing that should prevent our industry from saying, by the way, the realtors go through like 60, 70, 80 hours. I mean, it's a lot.
Right. It's very intensive.
Okay? Very intensive. There's
but it
all
didn't
kinds
used
of
to be. It
levels.
used to be very easy. In the early 90s,
That's right.
It was very easy. And there was lots of problems with real estate. A lot of part-timers and lots of problems in the early 90s with real estate agents.
But let's face it, as mortgage agents and brokers, we are in the category of a form of financial advice. Now, yes, the people who are making the decisions on the lending, we don't make decisions on lending. Mortgage brokers and agents, no matter what you think, no matter if your mortgage broker or agent says, yes, I'm going to make sure that I know this was approved. Well, they really don't. I mean, they're not the ones who are lending the money. Okay. Right. There's a lot of ones that are great experts, very knowledgeable, very honest, that exist. There's a bunch, not so much.
Right.
Okay. And the problem, I believe, is, just as Nick is suggesting, that the education barrier should be better.
Right.
And by the way, it probably should be more expensive.
100%.
Okay. Like, it shouldn't be $1,000 plus the course plus E&O insurance, and bingo, you are in 3 weeks a mortgage broker. Like, you're gonna go through your application, but you're gonna be fast.
Even with the level 2, like I always say, when you create policy, you always need to think through the unintended consequences.
Yes.
Part of the unintended consequences of this is a person doesn't have a level 2. He's just an agent. He gets an application from a borrower, gets all the application, all the documents he required.
Submits.
He submits, and he thinks he can get it done at Equitable Bank or Home Trust. They decline it. And he says, oh my God, I got to go to a MIC now, or a private lender, but he doesn't have the proper licensing. So he goes to somebody in his office that does and says, can you do this deal for me? Oh, and by the way, I need to make $5,000. So now the fee's doubled for the borrower. Now
So
the borrower's
true.
paying twice.
So true. So true.
Right?
So true.
So I think if you just raise the bar on education across the board, let everybody do everything, but you're giving them the skills and the knowledge to do it, everybody wins.
So that's a really...
Who loses by less education?
No one loses. It's impossible. The more... and by the way, tougher real exams, tougher education, so that, you know, there's a lot of subject
It's
cover.
the same thing to get an administrator's license to run a MIC. You know, there's really no requirements. I can be, and I'm not knocking plumbers, but I could be a plumber and all of a sudden apply for my license and get it. Like I always say, just because I eat in a restaurant doesn't mean I know how to run a restaurant. Like it's a discipline. There's a real skill set into running these things.
And Nick and I have talked about this before, but one of the things that always has amazed him and I is that today, almost all the new entrants to the mortgage investment corp space are brokers. They're mortgage brokers.
Right.
Okay. They don't have a background in lending. Now, some of them do. You know, they were in lending for a little while and they got into the business of mortgage brokering. But like, to my mind, I would rather see more people who are from a pure financial background,
Right.
like who were working at banks, who were in an executive
Understand
position.
credit, market risk, operational risk.
Understand the cash management you just talked about. Understand how important it is to manage to the covenants of your agreement with your investors.
Right.
Okay, and understand what governance really means. I mean, like, let's face it. I'm going to be honest with you. I've been a mortgage broker for gonna be close to 29 years now, and there's nobody ever talks to a mortgage broker about governance, and yet governance in the lending space is incredibly important.
100%.
Okay. So yeah, it's been a pet peeve of mine, and I know Nick feels the same way, that there's just so many mortgage brokers put up their hands and says, you know what? I'm doing a hell of a job at this, pounding these mortgages out to the people. I should be a lender too.
Right.
You know, let me raise some money.
How hard is that? And I would say it's easy lending the money, hard getting it back.
Get the money back and protect your investors.
Right.
Okay. Which is something that consistently bugs me, is some of the situations that we see. Because you told me a great bit of information about the TerraView information. TerraNet.
TerraNet, yeah. So we have a subscription to TerraNet, and what we're able to do is basically at the end of every month go in and slice and dice by companies and see
So your peer group companies.
Group companies. Yeah, we don't care what Royal Bank's doing. We know they're doing lots.
Yeah, yeah, they're doing well. They're doing a lot of mortgages. Yeah,
I don't need to look that up.
No.
But we look at our peer groups, and we look at it's Ontario only, but it tells us what cities they're lending in, how many units and dollars they're doing. And what I've been seeing this year is a real transition to lending in these small towns and small communities, which is a red flag, right? Because generally people do that in tougher times to get bigger yields and bigger fees.
So let me explain that to the general public who's and probably just half the mortgage brokers who are watching this. So if you really restrict your lending to just urban, suburban, but very specific, such as Nick does, and say we only lend in Ontario, only lend in Toronto, GTA, London, Kitchener-Waterloo, Ottawa. We're and we don't lend in the little towns, and we don't lend in rural, and we don't lend this. So that's now. And by the way, for everybody who lives in Perth, okay, so have you heard of that place? Perth?
I do.
Okay,
because
there's some of them we've never heard of before.
Yes.
Okay, but for everybody who lives in Perth, we love you. You're good people. RBC's doing your mortgage, or TD's doing your mortgage, all good. We're not beating up Perth, okay? But at the end of the world, in the private lending business, in the mortgage investment corporation business, doing a lot of lending in Perth is not the wisest move, okay? Right. Because things can happen in Perth, right. And if people stop paying your mortgage,
harder to manage, longer to sell, values aren't as kind to you when
and
things go
the
bad.
Market's an unknown.
Right.
Like, I mean, here's what I say. If you talk about Central 416 of Toronto, I mean, you know, it is a very big, very sophisticated city, and the people who live in the Central Core 416 tend to be, I'm just going to have to say it out loud, they tend to be kind of the elite of Canada. Well, not the best people in Canada, but all the head offices are here. Okay.
But you also look at in the core of the city real estate we're talking about.
Yep.
These homes generally sell once a generation.
Yeah, people stay in the houses.
People don't buy these houses because they want to buy because of the location.
Yeah,
like they're
so important.
Right? They want the location. So they'll live in something a little smaller. They'll live in something without a driveway or a garage. They want the location. So they're willing to sacrifice things for that location.
And school district.
Right? So what happens is you don't get the sales activity. Like you don't get the listings.
But the desire is there.
But the desire is there. So even now when you drive in these communities and something's listed, if it's priced reasonably right, gone in less than a week.
Which
even
may not
in
be
this market.
that may not be true of Perth.
Correct.
It may not be true of Perth.
Yeah.
It may not be true. And we love you in Perth. You're all good people.
But people aren't renting buses to take people out to Perth to buy.
No, they're not. So the bottom line is when Nick sees this long list of very small centers where there's a lot of private lending going on, what he means by reaching for yield is because there's fewer lenders willing to do those mortgages, that you can ask for more.
Correct.
You can ask for a higher rate. You can ask for a higher fee. And that's interesting.
And I'm not saying they're all going to go bad.
No, not at all.
But all it takes is one or two to create a lot of pain.
Because again, same reason you don't lend on cottages either, right?
No, we don't lend on cottages.
Because the reason behind all that is, again, the same central core philosophy that there are phases to cottage buying. Okay,
Correct.
there's years where it goes big, really big. Like I think we may never see the 2021 Cottage Year again.
Ridiculous.
It was absolutely nuts. Okay, but there's years when it gets quiet as 4 a.m. on a residential street. Like it's quiet.
Yeah.
Okay. And you can't
the
sell
Globe,
the properties.
the Roller Page did a study and they said, 65% of Canadians want to buy a cottage. But you know what? We could also do the same study that 65% of Canadians would like their own private jet.
Absolutely.
I would.
And
Can't afford it.
and 65% of Canadians want a condo in Florida.
Yeah.
Okay. Or a condo in California.
Doesn't mean it's
There's
going to happen.
Lots of wants. Lots
Yeah.
of wants. Okay. But the other, and that's the real key about a cottage. Like if you've got a secondary home, that means you have a primary home.
That's right.
So when things go wrong, as Nick says, bad things happen to good people. When things go wrong, you will fight tooth and nail to keep that primary residence going.
Right.
But that may not be true of the cottage.
That's right.
Okay. And if you're in that one bad cottage year where it's quiet, so quiet, where listings last for the whole summer, that's not good for a lender.
That is not good.
That is not good. There's all the costs we talked about. There's the difficulty of getting it sold. And that's why when you see a long list that includes Perth, Ontario, and Paris, Ontario, and La Regionale, which is up in the Ottawa Valley, and maybe that's one you've never heard of. Deseronto, yeah, another good one. Okay.
Years ago, I had a problem there.
I bet you did. By the way, Leamington is a nice town, but you probably don't want to have the mortgage on a lot of real estate there. We love you in all those towns. We love you people. You're great people. But at the end of the day, when you see a long list of lenders who are doing lending in these really out-of-the-way places, you've got to question if the economy really turns, if the housing market really turns. That's a dangerous place for the investors in those mortgage operations.
Well, and those secondary markets are the slowest to move up and the fastest to move down during the cycles.
Because when there's no action and there's little employment in those places, there's no buyers.
Yeah.
It's as simple as that. Nick, it's been a pleasure having you. Oh, I'm going to tell one quick final story about when I think it's the first time I've told Nick this story before. And it's one of my absolute favorites because it actually became one of the foundations for what when I was in the lending business and how to think about, particularly how to think about private lending and alternative lending, stuff for Home Trust and EQ Bank and Community Trust. When I was a property that I thought that should get a mortgage. I got a client. I was very new in the business. Like a long time ago. It was like 27 years ago. So I was fresh in the business. I had a lead. I had a guy who wanted a first mortgage on a property, and it was a bit ramshackle down in Mississauga. I mean, it would be great today, but this is 27 years ago. Mississauga was a little bit different place, and it was right beside the sound barrier on the QEW. Like that was his neighbor. He was at the sound barrier in the QEW. So I thought it was a great application. I put it in, and Home Trust said, "Nah, we don't." The underwriter said, "We really don't like the real estate." And I said, don't like the real estate. This is a great mortgage. You guys, what's wrong with you? It's just a mistake. I need to talk to a boss. Well, there's a boss. It's the underwriting director's away. No, I want to talk to a real boss. I want to talk to the boss. I want to talk to somebody who can make a sensible decision. So eventually I got to talk to Nick. And Nick listened to my story. But he repeated, like, hey, it's a ramshackle house. It's kind of beat up. It's kind of been chopped up into different units, and it's not what we're interested in. And it's right beside the goddamn sound barrier to the QEW. I mean, this is not prime real estate in any way. And I said, God damn it, Nick, I think because I should actually have been calling him Mr. Kyprianou, because I was just I was a nobody, actually. Like
nobody would call him that.
I was like a mortgage ant at the time. Okay, I was an insect in the mortgage business. But then Nick said the most perfect thing to me. He said, well, I'll tell you what we'll do. We'll put the mortgage on that property. Oh, good. He says, but we're going to cross-collateralize your house. You love this property so much. You love this mortgage so goddamn much. You should have no objection that you would co-sign for these people. Like, you should not fight that, right? Because you're telling me how good a mortgage this is. So you should be fine co-signing for it. And, I was mad for like 2 days. And then at the end of about the third day, when you cool off, I said, yeah, he's exactly fucking right. Okay, like, if I'm pitching this so hard, I've got no commitment, like none. But because the minute that he said, well, then you commit, I decided, no, this guy's a dick. I don't want anything to do with that more. I would never co-sign my house. So I learned at that moment, it was a meaningful moment. I never forgot. 27 years later, I still tell the story. It was a meaningful time because I suddenly understood that when you're in the lending business, you're not just a salesman. There's two sides to the lending 100%. Business. And if just so many mortgage brokers, so many mortgage agents, all the new people, don't get me wrong, there's a lot of great mortgage brokers who think the right way.
Oh, 100%.
Who know their stuff, who don't want to ever jeopardize the lender, who don't want to ever do a wrong thing.
Right.
But for all the new people and for all the, because Nick and I have met them, for some of the not so savory people in the business, because there's a few, that taught me something. It taught me that there's two sides to the business. And if you don't respect the other side, you're not really doing your job. So thanks to Nick for that. I never forgot it.
Oh, thanks.
And thanks for coming in. We really appreciate you having on the podcast.
Lots of fun.
I loved it. Thank you so much.
Thank you.
Okay.
If you like the pod, well, don't just sit there. Go to YouTube, Apple, Spotify, and all the other ones and like the pod. And don't forget to subscribe so we can keep being angry at mortgages and swearing about mortgages. Angry Mortgage could use your support.